Let's be honest here. Nobody wants to see a dividend stock that they own cut their dividend. Some investors put a ton of effort into making sure they identify dividend stocks with a healthy dividend payout ratio. Other people randomly select dividend stocks and they happen to work out well, but they put very little effort, if any, into evaluating the safety of the dividend. Either way, most investors at some point along the way are going to have to deal with and manage a dividend cut. So what are the big factors we need to be aware of so we can make a quality decision when we're dealing with a dividend cut? Let's talk about here, why would a company actually cut its dividend anyways? Are they just out to get you, or do they potentially have a very valid reason for cutting the dividend? Remember that dividends are paid from a company's profits. And if the company has no profits, well, they really can't pay a dividend. Now, in theory, they could continue to pay a dividend if they went out and borrowed money, and some companies have actually done this in the past. Went out, borrowed money just so that they could pay a dividend. I think we can all agree that that is not a healthy or sustainable option for a company. Generally, a company is going to cut their dividend when they are not able to effectively pay out from their actual profits. Or it could be just due to like a significant event that happens. Think COVID or the housing crisis. And it also depends on how healthy a company is before some significant news comes out. For example, some companies were already not doing well financially, and then we had COVID, and then they went and cut their dividend because they had okay financials, but then they also had this significant news out there. There was a lot of unknowns whether or not it was going to affect their business in a drastic way and how long it was going to affect them. And then you saw some companies that had excellent financials and they were able to weather the COVID crisis and get through and continue to pay a dividend and increase it. Most dividend investors evaluate the health or safety of a dividend with what's known as the dividend payout ratio, and there's a number of different ways to calculate this. The most standard way is with net income. Specifically, dividends paid divided by net income equals a percentage, which is your dividend safety. I personally like to use dividends paid divided by free cash flow, specifically because free cash flow is exactly what's available to pay a dividend. The cash. And then there are some other unique ways to calculate dividends for real estate investment trusts, and one we talked about recently with master limited partnerships and distributable cash flow. So when a dividend cut happens, we need to think about, what are we going to do? And better yet, we need to think about in advance of a dividend cut, if we eventually experience one, how are we going to handle it? What is the specific criteria we're going to look at? Thankfully, I have been very blessed to not have to deal with any dividend cuts at all. And I think part of that has to do with the measure at which I evaluate dividend stocks and specifically dividend safety. But I anticipate that's going to happen to me at some point along the way. The dividend's going to get cut. The very first thing I need to think about is, why do I own this dividend stock? Now that sounds like a simple question, but it's a very critical question that we need to actually answer honestly when we deal with a dividend cut. For example, let's say we own a dividend stock that has a really high dividend yield. We own that dividend stock because of the high dividend yield, not necessarily because we're expecting to compound the dividend growth over time for many years. We expect a relatively flat dividend, growing a little bit, and we expect that dividend will continue to be paid, but we're not looking for massive share price growth, and we're not looking for massive dividend growth here. On the flip side, we could be owning a dividend stock because we expect that dividend to continue to grow. Maybe the dividend yield right now is only 2.5%, 3%, maybe 3.5%, 4%, and we all of a sudden are dealing with a dividend cut, and we're thinking, man, the whole reason why I own this dividend stock is because it's supposed to continually raise its dividend. But now we're going backwards on our dividend. That is completely in the opposite direction of why we own the dividend stock. I'll give you an example out of my own portfolio here. Avgo, which is Broadcom Incorporated. I own 9.583 shares, which has a current value of $5,762. It's trading at $601 per share. Now here's Broadcom on the dividend stock spreadsheet. You can see here, it's got 13 years of consecutive dividend payments. This right here, this is why I own the stock. The 1-year growth rate, 11.6%. The 3-year growth rate of the dividend, 24%. Then 42%, then 43% over the past 10 years. The dividend yield right now is only 2.75%. And this is the dividend yield right here, 2.75%. And the dividend payout ratio based on free cash flow is only 55%. That tells me two things. Number one, that dividend is super safe right now. But more importantly, that dividend will continue to grow in the future because they have so much room available with their payout ratio. If Avgo, if Broadcom, if they cut their dividend right now, that is a huge problem for me because the whole reason I'm owning that stock is because they're growing their dividend at a rapid pace. If they're now cutting their dividend, the reason I own the stock no longer exists. All right, so I have here my daughter's latest artwork. Check this out right here. Now, this is really cutting edge work and reminiscent, I think, of Van Gogh and Picasso himself. I'm excited to offer you a once in a lifetime opportunity to invest in shares of these priceless works of art. Okay, so maybe not. But that's where Masterworks comes in. You guys know I'm a huge dividend investor and I love investing in the stock market. But the stock market has been crazy lately and many investment firms are projecting real returns of 5% or less and potentially even negative growth. I recognize that many people put a high value on diversifying their investments. Some people choose real estate, others choose to start a business, but did you know you can actually invest in art? Now, if you're skeptical, I will lead with this stat. Contemporary art prices have outpaced the S&P 500 total return by 164% from 1995 to 2021. Masterworks.io is the only platform out there that allows you to access these types of exclusive investments. They were founded in 2017 and are currently valued at over $1 billion. They have 75 collective years of art buying experience and are one of the largest buyers in the art market today. Masterworks knows what they're doing and they returned 32% to their investors in 2020 and 31% in 2021. Getting started with Masterworks is easy. It just takes a few clicks. Visit their website, create an account, browse their artwork, and create a diversified portfolio of some of the most stable assets around. If you want to sell your position before Masterworks has a buyer for their artwork, you can sell your shares to another art investor in Masterworks' exclusive secondary market. If you want to learn more about diversifying your investments with Masterworks, check out the link in the description below. Now on the flip side here, let's take a look at my high yield dividend account. My yields range from as low as 5.17% all the way up to 13.96% with the Russell 2000 covered call ETF RYLD. Now the reason why I own every single stock here for the most part, especially the higher ones up here, these higher yielders, is because of the high dividend yield. It's not for rapid dividend growth, though that would be awesome, and it's not for massive price growth either. It's because they pay a high dividend yield right now. In fact, if the price stays neutral or even loses a little bit of value, that's a win for me because I can collect more shares and my dividend payments can be reinvested at lower prices or at least the same price. More shares equals more income in the future. Let's say hypothetically, and this actually does happen from time to time with QYLD and RYLD, but let's say even Logistics or Arbor Realty, if they cut their dividend from, let's say, 97 cents a share quarterly to 90 cents a share quarterly, they still are going to be paying over 8%, maybe 7%. That's still a win for me. I still am getting a high dividend yield for this stock. As long as there's no fundamental major issues with the company that I don't think are going to resolve themselves rather quickly, then I'm going to keep owning this stock, even with that dividend cut. Same thing goes for the other companies in the portfolio, of the high yield portfolio. So for me personally, if I've got a high yield dividend stock and I own it for the high dividend yield right now, and they cut their dividend, depending on the size of the cut, of course, but for the most part, I'm thinking I'm just going to hold. I'm going to wait it out. I'm going to continue to buy low and continue to get more shares at this lower price in anticipation that the dividend will stay flat still or potentially grow in the future and the price will actually come back up and add more value. But what do we do here if, like I showed you with Broadcom, what if the dividend gets cut and it's now the reason I own the stock no longer exists because the dividend's not growing, in fact it's being cut? Honestly, for me personally, I'm selling. And this can be a struggle to do because most of the time when you have a dividend cut, it is followed immediately by a drop in the price per share because other investors are thinking the same thing. If Broadcom has cut their dividend, I don't want to own this stock anymore because the dividend is being cut. So I'm going to sell even if I have to take a hit on price a little bit because I feel like I can then reallocate those assets to a dividend stock that is going to grow their dividend. And also I'm going to take that time to evaluate, well, what did I get wrong here? How did I not see this coming? Because one of the reasons why I like to use dividend payout ratios based on free cash flow is it gives us a window into what's going to happen in the future with a dividend stock. Because most management teams of a company are going to wait as long as possible and try as hard as they can to not cut the dividend because they know so many people count on the dividend. Usually we can get that forward view with the free cash flow per share. So I want to evaluate in that case, why did I miss this dividend cut? Was there something I could have seen in advance that would help educate me for future investments? The big takeaway here is this: if we own it for the high dividend yield, evaluate whether you're still happy with the yield now. If so, maybe we just continue to hold that stock. But if you don't like the yield, now might be a great time to sell. On the flip side, if we're owning a stock for dividend compounding and growth over time of the dividend, and now they're cutting the dividend, in my opinion, what I'm going to be doing with my shares, selling the stock, finding a better one to reallocate my capital. Hopefully you found a ton of value out of this video. This video right over here is going to be a great next follow-up video for you to watch. Make sure to leave your 2 cents down in the comments below. I respond to all comments on the day I post my videos. That's all I got for you guys in this video. Have a great rest of your day, and please continue to stay healthy, both physically and financially. Have a good one.